Following program is sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday afternoon, and if it's Friday, we're going to be talking about money. You know, over the past 5 years, over the past 6 years, I've been talking about three themes. One is the super cycle and a long-term bull market. Two is the place of the Dow reaching six figures. And three, how is it going to end? It's not going to end for a while, not for a number of years. But within that framework, what happens between now and the time it does end? Well, a lot of the information for today's program is going to come from a book called Bold, How to Go Big, Create Wealth, and Impact the World by Peter Diamandis and Stephen Coulter. But I want to begin with a question today. Big question. So what do you think will be the greatest achievement of the Obama administration? Whether you like the president or not, there have been things that have happened. Not everything has been negative, no matter what you think. So what do you think will be the greatest achievement of the Obama administration? I'll give you what I think later in the program. That's coming. But you know, back in the 1950s, John Kenneth Galbraith wrote a book called The Affluent Society. And he was fairly right for the time that he wrote it. He wrote that the capital to grow the economy was locked up by big companies and big banks, and they made slow improvements. They did make improvements, but the growth was going to slow down. They controlled the capital. They didn't have an incentive to do anything that was really disruptive. They controlled the capital. They controlled the actual growth of the economy. Those were the big companies. And he said because of that, we'd reached a maximum state of influence, of affluence. You know, at that time, the average home was 1,100 square feet. He said that's going to be as big as homes get on the average. The living standards, living standards were really good. Almost every family had a single car. That was good. Almost every family had a telephone. Almost every family had a radio, and even some had a TV. You know, many of those things that he said were the affluent American. Comparing us to the rest of the world, we looked wonderfully affluent. We looked very wealthy, having one car, having 1,100 square feet. You know, it was, at that time, a time coming out of World War II when things looked very good. We were building freeways. We were building airports. But transportation system was really good. It was mostly buses, but things were moving along. He forecast that we had reached the peak of affluence. Well, you know that's not true anymore. You know that instead of being 1,100 square feet, the average house is over 2,400 square feet. Instead of having one car, most families have 2 or 3 or 4 cars. You know, most of the people, a greater majority, have gone to college than those who haven't. And it wasn't the large companies that came to dominate technology, but the small companies that grew out of it. It didn't happen the way that John Kenneth Galbraith thought it was. And one of those reasons is because the capital wasn't provided by the big companies or the big banks. In 1957, George Doriot started a company called ARDC. Doriot's considered the father of venture capitalism. He was a former dean of Harvard, and he founded a company called InSeed. And he wanted to encourage the private sector investment into businesses from returning veterans, those returning from World War II, those that had come back, those men, mostly men, who had given years of service in fighting World War II in Germany, Japan, in Italy. He wanted to form capital so that they could start their own small businesses. And what he did was to start something that was to attract capital all over. He brought several families together. He brought wealthy families together. And prior to that, you had angel investing. If you go back into the 1800s, for example, when Hall went to Mellon and asked for money because he'd come up with this process of an anode and a cathode and a cryolite bath and alumina, and he was actually able to make aluminum. He got a $25,000 investment from Mellon to build a company which today we call Alcoa. But it was a single individual person asking for money from another individual. It's the angel investor. But now, in 1957, a change took place because now they were accumulating wealth from accumulating funds from several families and investing. And of course, what made ARDC very attractive is they made a $70,000 investment in a company called Digital Equipment. Digital Equipment Company was a company that didn't build a mini computer. Actually, it was a mini computer that they built. It wasn't the huge mainframe like IBM. It was a small computer. I remember because in a former life when I was with Intaco Aluminum, we bought the Digital Equipment computers. General Data made a computer as well. They were mini computers. They weren't the PCs. They were bigger than that. But it was a trend. It was a beginning. And that $70,000 investment made by ARDC into Digital Equipment Corporation returned when it went public $35.5 million. And suddenly you had a visibility of what could happen when people put money together to make venture capital. After that happened, of course, some of the employees went off to form Greylock Partners, and one after another, venture capital companies formed. And it was out of that period of time that we ended up with the venture capital industry. By 2007, before this break, U.S. companies founded by entrepreneurs, financed by venture capital, had created, just in 2007 alone, 10.4 million jobs. Just in 2007 alone. Those companies generated $2.3 trillion in revenues. 18% of GDP came from companies that were financed by venture capital. If you look at Silicon Valley alone today, the company.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I asked the question at the very beginning of the program, what in 20 years or 30 years will be remembered as the most significant accomplishment of the Obama administration? A lot of people will probably say Obamacare. And I believe that it will be considered significant. Politically hot, not unlike Social Security, which is now 70 years old, not unlike Medicare, not unlike the FDIC. All of those were very, very controversial things. But I think it's had a significant impact. Donald Patrick Moynihan said, quote, "Everyone's entitled to their own opinion, but they're not entitled to their own set of facts." You know, the facts with Obamacare is it did not kill net jobs. Healthcare costs, which were increasing very rapidly. You know, I used to quote on the radio, before Obamacare was passed, that if healthcare costs continued to increase at the same rate they were, that by 2070 they would be 98% of GDP. Couldn't continue. Healthcare costs have come down, and the fact is most people are covered by, a lot of people are covered by insurance that hadn't been before. But that's being said, I don't believe that 20 years from now, the Obama administration will really be remembered for Obamacare. I believe the greatest accomplishment of this administration is something that went by, not highlighted, but a thing passed in 2012 called the Jumpstart Our Business Startups, the Jobs Act. The Jobs Act allowed new businesses to use crowdfunding to raise early-stage capital. They could use Facebook or Twitter or Instagram or other online resources to raise capital worldwide. Estimates today place the amount of capital that's going to be raised at over $300 billion. And I'm not sure that that isn't an underestimate. I'm not sure that it's not going to be in excess of $1 trillion or several $1 trillion. Venture capital wasn't estimated to be significant either. And think of what that's done. Venture capital was originally started to help veterans returning from World War II. Right now, crowdfunding, estimated to be $300 billion. But by 2012, when Jobs was passed, there were already things that were raising money online. Most notably, Kickstarter. Started in 2009. New York Times called it the People's National Endowment. It was raising money for creative ventures. In 2010, first full year of operation, it raised just $27 million from 3,910 people. By 2011, the $27 million had grown to $99 million, and the 3,900 had grown to 11,000 people donating money. By 2013, it had grown to $480 million from 19,911 people. And last year, $529 million from 22,000. They were raising over $1,000 a minute. That gave people no ownership. We had Mike Cylinder from talking about money he raised on Kickstarter. He raised $107,000 for a board game. No ownership in the company, but the people who actually put in money were going to get a game out of it. And Kickstarter was raising 5%, very typical, 5 to 10%. With Jobs, it created the possibility to raise money for equity capital. Equity capital. Whereas Kickstarter was not equity, it was raising money for creative projects. You had Kickstarter, you had Indiegogo, you had Rocket Hub, and others raising money that way. With the Jobs Act, it started allowing people to raise money for equity investments. There's now over 700 crowdfunding websites that exist globally, and they existed before we did the Jobs Act. In 2009, $530 million was raised through crowdfunding. By 2011, that had increased to $1.5 billion, and in 2012, $2.7. And the projection for this year is that crowdfunding will raise $15 billion for startup companies. Sites charging 5 to 10%, but it's that capital that's raising that's a parallel to the venture capital that came in the 1960s and 70s. Think about that. Just looking at one site, Crowdfunder, one equity site that started in the U.S. Last year, at the end of July, with a little over a year in operation, they'd raised $105 million for 11,000 companies from 62,000 investors. Think about that. Investors investing $1,696 on the average. Venture capital, you have to have millions of dollars to participate in a venture capital. Venture capital, you're looking at putting in $10 and $15 million into company. Here's away, crowdfunding. Average investor, $1,696. Some may be as little as $25, some $10,000. It's a big number of small investors instead of current venture capital, which is a small number of big investors. And unlike venture capital, it's a different approach, but the focus is the same. It's not like traditional. And some people, for their $1,000 or $1,500, they're going to see their equity grow 1,000 or 10,000 times over. Think about it. Investing 1,000 and making $1 million, that's going to happen. Investing 10,000, making 10 million, that's going to happen. And a whole lot of projects are probably going to die and go under. That's the way it is. And the approach is not limited to the U.S. It's a worldwide approach. The internet covers the entire world. It means that investors in Africa can invest in the U.S. It means that investors from Asia, from Eastern Europe, can invest in companies in the U.S. And investors in the U.S. can invest in companies that are starting up in India, starting up in Bangladesh, that are starting up in Mexico, that are starting up in Peru. It allows an international, worldwide set of investors going both ways. Now, if you remember, one of the things that I've talked about again and again over the last 6 years is the Standard Chartered study of the supercycle. Standard Chartered Bank did a study 6 years ago, released in 2009, in which they talked about supercycles, when worldwide growth grows, or worldwide GDP grows at a faster rate than average. The first supercycle from 1870 to 1913, 43 years, was driven by the industrialization of the United States. The second cycle, from 1945 to 1970, a cycle of 35 years. It's important to remember, these are long cycles. 35 years was driven by the rebuilding of Europe. And of course, there's a lot of other things that were going on as well. The new cycle, from 2009 to 2025, 2030, how long will it go? Who knows? It's going to be driven by the growth of the emerging markets. By 2030, the forecast is that 93% of the world's middle class will live in these emerging countries. They'll be consumers. Companies that are started in the U.S. and in the world are going to benefit. And the funding mechanism for those companies, I believe, is already in place. Invisible to traditional ways of thinking about raising capital.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So we're back, and my focus on the program, as I said, is to give you, the listener, greater insight and understanding of what's happening in the economy, in various industries, so that you can be better informed and you can make decisions ahead of the curve instead of behind the curve. That's true of my guest today, Ari Yu, the founder of a company called Gift Starter. So welcome to the program, Ari.
Thank you for having me.
So let's start with your background.
My background is very unusual for a person in tech. Do you want the shortened version?
Give us the version, whatever you feel like.
Okay, well, let's see. The first 20 years of my life, I dreamed of going to Juilliard and being a concert pianist. And so spent the first years of my life very focused on that. As you can imagine, being behind the piano a lot, you don't really get out to socialize. And so when I got to college, I realized I wasn't very good at the people thing. I was really good at capturing hearts with the piano and the music, but I wasn't very good with my words. And so I learned the art of event planning and community building. And so that was my second, I guess, phase or career. And I started this thing called Socially Conscious Bar Nights in Seattle, grew it from 6 people attending every month to about 450 people attending monthly. And so I got a lot of good practice out of that. Mm-hmm. And through the world of event planning, I landed this job at Microsoft helping with events for their sales folks. And the general manager there, in my early 20s, he looked at me and he said, "Hey, you can do math, right?" Like, "Yeah, of course, I can do math. Yeah, sure." So he said, "Well, why don't you join the team and become a business analyst?" And I said, "All right, sure." So that began my third career that I've had so far in my short life, which is I entered the world of IT and software and technology, and I fell very much in love with it because there's so much you can enable in terms of human life quality through technology. And so I spent the last 12 years of my life building technology teams and businesses, mostly on the IT management consulting side. So that's my background. But now I'm in the world of startups.
And you are starting a company called Gift Starter. So let's talk about what Gift Starter is.
So Gift Starter, you can see that it plays on the name Kickstarter. It's crowdfunding for gifts. We allow people to make partial payments towards anything that you can buy on the internet. So that's in a nutshell. What does that mean? So what we do is, say you wanted this, Vitamix is really popular among a lot of young couples today. $500 Vitamix, we break that into squares, a grid of squares. And so as a user, you can say, I'm going to split it into 2 pieces or 20 pieces. And then you can buy it piece by piece by yourself, squares by square off the grid. And then maybe your birthday happens and you go, "Hey, mom and dad and aunts and uncles, would you like to buy another piece?" And they buy 1 or 2 more squares until it's funded. And then once it's funded, we send you the Vitamix.
I think of about, the wedding registry where the bride will go to the store, whatever it is, Nordstrom or Macy's. I wanted to say the Bond's gone. Yeah. But they sign up for a gift registry and they put down they want this type of tableware and they want, the type of glass and so on. It's the same kind of concept because one person after another will come in and buy 2 plates or they'll buy a serving dish or whatever. You're allowing them to do that online with a lot more than just a wedding registry.
True. And also, if you look at modern couples today, we're getting married later. We're already having our apartments before we get married. And so by the time we get married, we already have those plates very often, and we already have our first blender. And now we're looking for the upgrade to the college sofa that you dragged into your new sofa with your future husband, for instance, right? So we're enabling something bigger now.
Now, there are some sites that people could sign up for and say they wanted to raise $3,000 for a project, whatever it might be. You're very different than that.
Correct. Different in that a lot of these crowdfunding sites, like GoFundMe, for instance, or Honey Fund, they allow you to collect payments from your friends and family. But at the end, you get a deposit into your PayPal account, for instance. And so you end up with this collection of cash, and then you're supposed to go and spend it on the things that you said you were going to spend it on. But then human nature comes into play, and sometimes it happens and sometimes it doesn't. The way we're different is when people fund these particular items for your birthday or your wedding or whatever the occasion may be, we actually deliver that specific product.
And so how many retailers do you work with right now?
We work with hundreds. On the technology end, we use product feeds from aggregators that take feeds from like Nordstrom and 1-800-Flowers and Kohl's and you name it. And so that's how we are able to service all the different products to our customers.
So walk me through, I want to sign up, I want to buy a bike, and I'll never buy a bike. Anyway, but for example, I want to buy a bike. I want to spend $1,500 because I found this bike. I Googled it. I found it on the internet. I want to buy the bike, but I'm young and I don't have a lot of money and I have maybe $50. Walk me through how I would buy the bike and how it would operate if I used Gift Starter.
Sure. We actually had one of our first gift campaigns was this exact same scenario. A person wanted this bike. Their previous bike had just been stolen, and so they needed a new one. And so what they did was search for the bike on our website. They found the bike. Then they decided on how many pieces it would be. And the more pieces you choose for that grid, the less each square is. And so each square, I think, was about $15 a square for that very expensive bike.
So can we back up a second? You say that they come to your website and find the bike. So I'm trying to visualize, because if I go on Google and Google bike, I find it not at Gift Starter, I find it at another store. So you're saying that they can go to your site.
They can go to our site. Side note is we are working on partnerships so customers can find our capabilities on like a Macy's.com, but we're still early on that road. So in the meantime, you can come to giftstarter.com. Similar to Google, where you do a search, you can search for bike or Schwinn bikes, and a whole selection of bikes will come up from all our different retailers that provide bikes, and then you can select the one you want. And once you select that one, you gift start it, and then you can choose how many pieces you want in that grid.
And then you let your friends know. Yep.
You have many mechanisms to invite your friends. Social media like Facebook, Twitter, and Google. You can email. You can copy the URL and text message it to anybody. However way you want to share, you are able to.
So through this whole process of using social media, you collect all your friends, and they each sign up for one box or two or three?
However many you want. You could have a cousin that's in college and maybe he can afford the $15 box. But my uncle over there, he can buy 5 boxes. And it's all about participation and people coming in with their own personal preferences, yeah.
And it sounds like a way to really integrate families and friends together.
Yes, it's actually very magical. Having, of course, dog fooding my own product and having used it many times, you end up with, friends in China that are buying pieces, and you have friends in North Carolina and Alaska, and even people here in the community, and they don't all necessarily know each other or have the same budget or the same schedule, but just seeing that community come together to enable something great for another is amazing.
I would guess that you even have people that don't even know that come together.
Yeah, we've had a lot of those too. I think one of our, Kyle Kesterson, he did a birthday campaign. Instead of gifts for myself for my 30th birthday, he said, hey, would you all donate some money to the Union Gospel Mission? And so there's a whole collection of people that came in on that charity campaign.
People that he never knew.
Right. And since we deliver product, we delivered sleeping bags, we've delivered socks and umbrellas to the homeless.
It's an amazing company. So tell us again, how do you get started?
You go to giftstarter.com and look for the product that you want. You can look on our gift ideas page. You can contact our gift concierge, who's your personal shopper, who's there any day to help you.
That's awesome. So thanks for being on the program. It's an amazing thing. In some ways, it reminds me of what we used to do when I was growing up, the layaway, going to the store and putting money down because you didn't have enough to buy anything, and you come in and pay some. But in this case, it's a lot more powerful because it's not just you paying for the layaway things. It's your friends, your family. It's a whole broad range of people, including a lot of people that you don't know, and maybe a lot of people from a different country that don't know you at all. It would be interesting to do a study and find out how many people become friends internationally because of it. I don't know if you've ever thought about that, but...
Good idea.
So, anyway, thanks for being on the program. Tell us one more time about your website.
Giftstarter.com, a place to afford anything on the internet and rally the troops with your friends and family to enable great, amazing gifts for each other.
Thanks, Ari. Great idea. We're coming up to a commercial break. Don't go away. We'll be back, and I want to talk about what's going on and where we are. Is there a lot of fear or not? We'll be back right after the commercial.
More about money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So we've been talking about money, and we're going to be talking more. And, you know, I want to shift gears. I got my undergraduate degree in math, my master's degree, of course, in business, MBA. But a lot of my approach is mathematical. And so a lot of the things that I talk about are based in mathematical or math facts or whatever. And so I like to pick up things where you have a game that demonstrates some principle. And a game that I've often talked about is a game where people start with $20 and they have 20 plays. Each time you get to invest $1. And it's based on a coin flip. Heads or tails. Heads, you win $2.50, a profit of $1.50 on your $1 bet. Tails, you lose your dollar. Very simple, very straightforward. It's in your best interest to play every single time, because half the times you get heads and half the times you get tails. Half the times you get $2.50 back, and half the times you lose your 10. So at the end of the game, your 20 turns into 25. 87% of the time, if you play every single round, $1 every single round, 87% of the time, you end up with $20 or more. Not a loss. Only 13% of the time do you ever end up with less than $20. Those are the stats. They're facts. You can't change those. Everyone's entitled to their opinion, but no one is entitled to their own set of facts. 87% of the time, playing every single time. So when this is run in a group setting, a normal group, each group, or the average of these groups, have invested less than 40% of the time. Every time that they turn up a tail, some people will stop playing the game. Every time that you have a couple tails in a row, more people will stop. And only when they begin to see a couple heads will they start again. 70% will quit after or quit during the first 5 rounds. And fewer than 50% will continue beyond 5 rounds. It's very similar in many ways to a bear market. Fear causes investors to completely shy away from bargains. I mean, a number of years back when Nordstrom would hold their sales, their half-yearly sales, people would line up for blocks to get into the store. They'd come at 3 and 4 in the morning to come get the sales of the Nordstrom merchandise. That was back when they sold the real stuff. But I probably shouldn't say that, but anyway, you look at the day after Thanksgiving and people line up, people will sleep overnight to get into the stores and get what's on sale. But when it comes to a bear market, you don't find people lining up to buy the bargains. You find people lining up to get out of the market. even when the market is up threefold from the bottom, you still have people concerned and scared. You have people concerned that Russia is going upside down. You have people concerned that China has devalued their currency. You have people concerned that the consumer is slowing down. You have people concerned that the economy in general is showing some signs of slowing down. You know, if you look at it in a short-term basis, it gets back to the phrase that's very common. The stock market always wants to climb a wall of worry. If you don't have a lot of worries out there, you know that the stock market is headed for a dump. It's really that way. If you look at the 20th century, you know, during the 20th century, that last century, we went through a Great Depression, 1920s, 1930s. We went through numerous recessions. In the 1913, 1960s, the 1980s, the 1900s, lots of recessions in between. We went through 2 world wars. World War I, the war to end all wars. We went through World War II, which was the war that followed the war to end all wars. We went through Korea. We went through Vietnam. We went through multiple conflicts. We went through a period of time of a Cold War, and we went through this conflict with communism. You know, during the 20th century, we had 2 presidential assassinations. We saw Chernobyl meltdown. We saw 3 Mile Island. We saw a multitude of problems and issues, all unpredictable. And yet, with all those negatives, on January 1st, 1900, the beginning of the 20th century, the Dow stood at 66. And on December 31st, 1999, after 100 years, the Dow stood at 11,467. Think about that. The Dow started the century at 66 and it finished at 11,467. All the things that went wrong, all the things that could have caused fear, all the things that were so negative. But you know what? We talk about the black swan of 2008 and 2009. The black swan, as if a black swan is a negative event. But think about other black swan events. Think about that company that developed a machine to calculate how to aim artillery during World War II. That company that estimated in their total time forever they were only going to sell 14 or 50 or 4 or 5 of those machines. You know, of course, that company was IBM. And of course, the people that were doing the calculations by hand were called computers. And the machine that was developed was called a computer. You know, we now have more computers sitting on our desks than they estimated we would have forever. That was a black swan event. Who would have thought? You know, at the turn of the century, one of the huge problems in New York City and in most major cities was manure. I mean, in New York City, they had piles 40 and 60 feet high. It caused disease. You had people that were employed to sweep the streets. You wanted to go from one side of the street to the other side of the street. You hired somebody to clear the street of the manure. I mean, that was our transportation. That's what did the big thing. But they left piles. You know, that all disappeared with the automobile. You know, the internal combustion engine, a black swan event. Think about the diseases, polio, whooping cough, all the diseases which we don't even think about anymore, all disappeared. Think about travel. You know, how many days did it take at the beginning of the century to get from the West Coast to Europe? Today it's a 9-hour plane ride. There's a long list of positives. The Dow went from 66 to 11,467. Those are black swan events. And we're at that point again. I talked about crowdfunding and the impact it's going to have. I think we're going to see a very significant crowdfunding effect. We're going to see disruptive technology. We're going to see things we can't even imagine. Who would have thought? Computers that we carry around in our pockets have more computing power than those big machines which took up a full room in the 1960s and 1970s. We're going to see things which we cannot even imagine today. And yes, the Dow will break 100,000 and the Dow will break 200,000. It's a long way to go. That's it for today. We're wrapping it up. I will be back next week. Have a very wonderful weekend. We're just beginning a wonderful ride.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Money Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following program is sponsored by Adams